Good evening, YouTubers. What a gorgeous day we've been having. What a gorgeous 3 weeks we've been having here out in Merritt, British Columbia. It is I, Mike Martins, your housing discussion guru. I'm not an expert. I am not, neither do I know how to read or have any education. But I'm seeing the writing on the wall and it's not looking good. And this is from, so I got a couple articles I'm going to put up here. And it's been all over the news. Even my man, Dabu7, big YouTuber, huge YouTuber with a couple of million followers, has been reporting on Canadian debt load 2. He did a 3-minute video talking about the higher enchilades selling out to the highest bidders. And basically, Canadians bought into this frenzy. He did a really good 3-minute video, and he got to the point. Unlike myself, I just talk too much. Anyways, so a couple of articles here from CNBC. What is that? Canadian News Broadcasting crap? I'm not sure what that is. It's probably American. Yeah, it is American. I'm just playing around. Canada's household debt levels higher than any other country, report says. So this is all over the news. This is an old article, and I want to bring it up because it's from November. And look at how they forecast this in the United States to what is happening after Q1 2018. And this is an older article, and it's good to look at older articles to see how spot on some of these guys are when it comes to forecasting or trending where the market's going to be heading, right? The OECD found Canada's household debt to GDP ratio had ballooned to 101%, significantly higher than any of the 35 developed and developing countries the group monitors. So people are just selling themselves out, signing on the dotted lines. You know, I'm so happy I have no debt. I have no debt. I have one credit card that I use for my shop because it's a corporate card that I just use to order and pay it off, and that's it. The rapid accumulation of household debt for Canadians could also leave its economy particularly vulnerable to shocks, organization said, and they're right on the money with that from Q4. This is before the end of Q4 2017. And right here, while virtually all countries witnessed soaring debt loads ahead of the credit crisis a decade ago, most of these seen their indebtedness reduce over time. But not Canada. Sold over asking, a playground for the rich. Household debt levels in Canada are higher than any other country, according to the report by the Organization for Economic Cooperation and Development. That's a mouthful, people. In a preliminary version of the report set to be released fully next month, which I followed up the report a month after, OECD found Canada's household debt ranked as the highest among 35 developing nations, countries, and group monitors. The rapid accumulation of household debt for Canadians could also leave its economy particularly vulnerable to shocks, the organization said, although parts in this reflect strong population growth. So, population growth is a really shady way to offset your GDP because it's a lot of money coming in from offshore. So, I'm going to keep reading. Population growth, these developments may entail significant risk of financial stability given the direct exposure of the financial system to the housing market, the OECD said. Risk of severe recession. Now, this is what they forecasted November last year. Now, what they say here, the group of Canada's household debt GDP, gross domestic product, ratio had ballooned 101%, significantly higher than the other nations studied. In comparison, the ratio for South Korea was the next highest and slightly under 93 points, with the UK third over 88%, and the US in the household debt GDP ratio was around 80%, while Germany and France were below 60 points. Research points to another number of links between the indebtedness and the risks of severe recessions, the group said. While virtually all countries witnessed soaring debt loads ahead of the credit crisis a decade ago, most have seen their indebtedness reduce over time. However, for Canada, some of the countries in Scandinavia, this has not been the case. The OECD is pinning the blame on inflation of house prices. Yes! And that's why I'm reading this article from November 2017. OECD countries have the have experienced the strongest increase in household debt since the crisis, have also the steepest rise in house prices, the group said. This is right on the money, and this is from, and then I was pulling out articles, kind of looking around, and I found this one. This one's right on the money. It was published Friday, the 24th day of November of our year of grace, 2017. Let me drink some of my lemon water. Let's move on. Before we get to Australia, let me just go to a couple of videos here I want to show you guys. That girl's awesome. Look at her. Whew. I saw that, I'm like, what? Okay, we'll leave those for the end. So this is brand new. This is a brand new article. This is from last week. 1 in 3 Canadians fear bankruptcy amid debt trap warning, says survey. Let's see what they have here to say. Oh, it's got stupid music. Let's see if they talk. Oh, there we go. There's some talking here. Okay. Once you put the stupid music, the video gets flagged, and then somebody else makes the income, and the video gets out there. But then if I remove the music, then I get a notice from YouTube saying that no one will watch this video anymore because the music's been removed. So that's how it works. Okay, so let me drop the desktop audio up. Mic
cards for indebted Canadians. Patty.
I always pay attention to a report that comes out on a quarterly basis by MNP. They're an insolvency company, and they look at the perception from the Canadians' point of view, of course, how they feel about their debt levels and what some of the wild cards are. And more specifically, they look at their concern over paying current expenses, an unexpected expense, and rising interest rates. So just going back to December, the concerns are certainly starting to mount. There's no question. 43% say higher interest rates, they're already feeling the effect of it. 1 in 3 say if rates continue to go higher, we could see ourselves being pushed into insolvency. When you think about it, 1 in 3, that's a big number. According to the survey, they looked at those individuals who have mortgages coming up for renewal, and more than half said they do within the next year or so. And so as rates have started to go incrementally higher, they say that they are not going to have any wiggle room at all. In fact, 46% say they're now $200 or less away from financial insolvency, not being able to pay their bills. And already 47% say that the situation that they're currently in means that they're going to have to continue to borrow to make their bill payments within the next 12 months. I mean, when you look at this report, and I know we're on the cusp of a Bank of Canada interest rate announcement, no one expects rates to go higher. But Carl, to your point, when you look out at the yield curve, no one's expecting inflation, and yet there are other indications that the bank could still move on interest rates.
Well, and that is actually what's shifted just a little in the last 4 or 5 weeks is some signs of inflation. Wage push have crept in.
Yes.
And have started to impact the expectations for short-term rate hikes. What I mentioned earlier is, and we find interesting, is that longer-term rates really haven't moved to any kind of significant degree yet. The 10-year yield in U.S. bonds is still in the 2.7 to 2.8% range. And certainly not talking about inflation being an issue over that longer period of time. And in fact, I would say, if anything, market participants are talking more about the fact that it's likely that the Federal Reserve and the Bank of Canada push the economy into recession by increasing short-term rates, flattening out the yield curve, and of course, if there's a recession, a year, 2 years, 3 years, whatever the number is down the horizon, you're not too worried about owning long-term bonds because typically rates fall in that scenario. So there's an awful lot of concern, and I think it's different in the U.S. versus Canada right now because of the pace of U.S. deficits and the possible track for that. But it's interesting to look at individuals and how significant 75 or 100 basis points can be in terms of the cost of that borrowing. And as you mentioned, there's an awful lot of people who haven't had to face that yet because their mortgages haven't come up for renewal. So
great to have you back, Patty Leverett.
Thank you.
That's wild cards for Canadians in debt.
Okay, guys, so that's the 3 wild card Canadians in debt from BNN. I want to thank them, courtesy of them. So we were talking about this in Trends in the Housing Market, which is on every Wednesday night, 7 p.m. Tijuana time, LA County time, Vancouver time, 7 p.m. Check your local listings for your time. Anyways, I've been talking about interest rates going up 1 point. We did the math on what when interest rates go up 1%, how much of an offset on on $100,000, 1% and 1% increase. You're looking at about. You're not looking at much on 1% on $100,000, but if it goes to 5%, you're paying close to 7%. If rates go to, so if you got rates at 1%, 1.5% where they were going at for a long time, you got them for next to nothing, and they creep up back to a normal housing market to 4.5 or 5.5%, and on $100,000 you're paying finance charges of about $6,800 a year per 100,000. So the people that bought the 1.3 to $1.7 million crack shacks are in a lot of trouble, right? So location means nothing if you can't pay for the location, right? 1 of 3 Canadians fear bankruptcy amid debt. This isn't exactly what they talked about in the thing. Basically, they just transcripted it here. So households, in quotations, currently showing signs of financial difficulty and living on credit are about to fall in debt trap if interest rates continue to rise or if they face an unexpected expense. So, like, if they get hit with financials, if they get hit with that, oh, my transmission stopped working. Go ahead and rebuild your transmission. See how much it costs on your car. But what I'm trying to say is people have been buying food off credit cards. Once you look at their total debt service ratio, and there's TDS calculators on the internet, and they're free. Okay, to type in total debt service ratio calculators. What's my TDS? Look it up, guys. Look up what your TDS is. Look up what your mortgage is. Look up what if you own or if you rent or whatever. If you're looking to buy and you're looking to take on a mortgage payment that miraculously becomes cheaper than your rent, but you got property tax, you got all kinds of stratas, all kinds of other bills you didn't expect. Go on my TDS, just look it up, see what your TDS is online, it's free. See what your car payment is, see what your credit card debt load is. Because remember, with credit cards, you're paying a blended rate. And it's phenomenal what you pay once you take that blended rate and add it together and see what you're actually paying in interest. It's phenomenal. Anyways, let's move on. I don't want to take up too much of your time. We've already been talking for 12 minutes here. Canadians scrambling to pay off debt as interest rates rise, says poll. All right, let's put this baby on.
Idyllic seaside. West Vancouver is one of those idyllic seaside.
Oh yeah, I took a look at this one. This is nothing to do. This one is about Airbnb, and somebody ended up trashing the place. They had a huge party. They rented the Airbnb, and they had like several hundred kids there, probably the whole school, and a bunch of strangers went in there and started partying it up real good. So anyways, a growing number of Canadians are worried rising interest rates could impact their ability to repay their debts. Just like the article I read, this is a new one. According to a new poll, the quarterly MNP Consumer Debt Index survey found 43% of respondents said they're already feeling the effects of higher interest rates in Canada, which is up 5 percentage points from 3 months ago. And that's not a lot of a hike. That's not a huge hike. This goes back to exactly what the other article was saying. Here we go. As more Canadians renew their mortgages this year, Gulling said that it could put a stress on households' monthly budget. For example, if your mortgage is $200,000 to $400,000 and there is 1 or 2% increase after the renewal, the households could be paying $200 to $400 more a month. Yeah, that's about $3,600 to $4,200. Yeah, so on 200,000, you're looking at about 2250. And then about 400. That's not including property tax, guys. So remember, you got property tax on the side. You got all this other stuff, eh? So $400 at 4, 12, 16, 24, 20, 30, 30, that'd be $5,700 a year more. So that's That's a lot of money, $5,200 more a year. That's a lot. It's a huge increase. So this may be enough to tip someone over the edge, Gowling said. And let's see what he had. That's gonna obviously it's gonna cost more to service your dad. This happens, people. This is business. When you walk into these $1 million crack shacks or $2 million crack shacks and hope that you could flip it over and make a bit of money, that's the risk you're taking. People need to realize that it's not the people can blame the realtor, the banks, at this. A lot of people are not educating themselves. Your house is the most important asset you will ever buy, the most biggest investment you'll single-handedly buy in your entire life. And you don't want to screw it up. But a lot of people have, and this is the problem. So let's see what he has to say here.
You're watching The Morning Show. Gillis. She is the director of credit counseling for Resolve Counseling, and also a client has joined us today, Ryan Nickel. And is Ryan a typical story of someone who had mounting debt and did see the light at the end of the tunnel?
Yes. I met Ryan years ago, and he is...
Ryan, you just sit back. We're just going to talk about you for a while.
We'll talk about you for a minute.
I like that. I like that.
Yes, Ryan is one of the people that we meet with that get the courage to come in and talk about their situation. I know that it's not an easy call to make, but he came in and met with us. His story was the story that we hear very often of someone who's young and trying to make their way and feeling the burden of debt. And he's very, I think it's great that he can come on and show that you can get to the other side of this.
Yeah.
Yeah.
I imagine those first few seconds of realizing you need help is difficult, and to pick up that phone.
It was one of the most difficult moments of my life. I was going into university at 19, fully in control, had all my savings set aside, had worked really hard to put myself in the position to be financially successful in going to Queens, a very costly expense. And then that power was taken away from me due to situations out of my control, and I found myself $19,000 close to in debt at 19 years old, told by the credit bureaus that I had one of the worst credit ratings that they had seen at somebody for my age.
They can't. That can't be good.
I was going through a deep depression, to be honest with you, and it was only because my friends recognized the symptomologies and said, you need to go see somebody that's professional. They recommended K3C counseling, and I called the phone, picked it up, and it was one of the best decisions of my life. It taught me the skills and gave me the tools I needed to realize a plan, get to the goal of paying off that debt, and then setting myself up financially for the future with the knowledge, with the mental tools that I have, as well as the financial knowledge of where I can go when I want to get a mortgage, when I want to do school when I went back at 29, and be able to get that OSAP because I paid my OSAP off at 19. Instead of running away from debt, I was able to face it and conquer it.
You talk about running away from it. It can only get worse if you don't address it.
100%, 100%. And I felt that. I had the credit agencies calling me saying, you owe us money, we're going to call your grandma, we're going to call your mom. They had all the threats on me, and at that time, when you're already stressing out not being able to go back to school because of finances, and you graduated to the top of your class and you had a lot of pressure with people outside saying, why are you not being in school right now? It's very hard to say, well, I can't afford it. I don't have the money to go back because I helped pay for my family's debts themselves. And unfortunately, you need to take power yourself, and that's what was going to K3C allowed me to do, is take that power back, get that hope, get that optimism, to see that commitment at the end. And I have to tell you, I finished my debt plan in 4 years when I had it for 5. So as I started going, the momentum picked up, I saw action happening.
Canadian families already in debt are getting in deeper. A new report shows consumer debt is climbing in Canada. During the first 3 months of 2017, non-mortgage debt jumped to an average of $21,000. That's an increase of nearly 2% over the...
So guys, they're talking about unsecured debt in this one. Non-mortgage debt is unsecured, where basically you use your signature as collateral. It's not secured on a mortgage. It's not a second mortgage. So this is unsecured debt.
Same period last year. Calgary has the highest average debt level in the country at $28,000. Most of the debt doesn't involve credit cards, but lines of credit and installment loans. That debt, combined with a hot housing market, could spell trouble. It's prompted a warning from the Bank of Canada that Canadians and the country's financial systems are more vulnerable to economic earthquakes. Shirley Engel reports.
Banks are giving cash out like candy these days through cheap, flexible home equity lines of credit, effectively turning Canadian homes into ATMs.
It's not just being used for a renovation or, to pay for a trip. It's being used to buy groceries or pay tax bills. What I don't see is people having a plan to pay that off.
The Bank of Canada echoed a warning about those loans from Ottawa's Consumer Protection Agency, adding a rapid rise in the number of Canadians tapping into home equity could make the broader economy more vulnerable to shocks.
The two most important vulnerabilities for Canada's financial system, that's the elevated level of household indebtedness and imbalances in the Canadian housing market, have moved higher over the past 6 months.
The ratio of debt to disposable income now approaching a record 170%, 90% of that increase from mortgages and home equity lines of credit. The bank is closely watching the red-hot markets of Toronto and Vancouver, warning more buyers are turning to uninsured mortgages, some from non-traditional sources. While the risk of a price correction is moderate, there's no sign we're headed for a U.S.-style housing crash.
It was related to a number of factors that are not present in Canada.
Still, the OECD is now urging Canada to raise interest rates to cool things off. But no indication the central bank is going down that road yet.
I think that the idea of using, an economy-wide hammer to address mortgage borrowing in two markets is misplaced.
I do think more regulatory actions are likely to be needed. I also think that ultimately higher interest rates are going to need to be part of the solution.
Overall, the Bank of Canada says the economy is resilient and showing signs of recovery, but with so much global uncertainty, that only provides so much comfort. Shirley Engel, Global News, Ottawa.
Governing Council considered.
Okay, guys, that's that. Holy smokes. So we've been talking about this every Wednesday. I've been talking about this for the last, couple of years. It's been 6 years now I've been talking about the housing crisis. Now, here is BNN. We gotta watch this. This girl's hot. We gotta watch this one. Okay, so let's do this here.
Alberta households are set to see the most pressure from interest rate hikes. That is the finding from a new report from RBC. Let's get those details now from Tara Weber. She's joining us from Calgary. Hi, Tara. Let's talk a little bit about this. The pressure on Albertans coming forward if, in fact, we get interest rate hikes.
Yeah, that's right. So here in Alberta, we are carrying the highest average debt loads out of everywhere in the country. Now, the majority of this is mortgage debt, but it's debt that's been increasing. So in 2016, we were carrying an average debt of roughly $192,000, and that's been increasing since 2010, when that number was a little bit lower at $164,000. Now, I should mention that in these numbers are also households that are completely debt-free. So that's making these numbers a little lower than they actually are for those that are carrying debt. Now, what this means is that Albertans are already carrying more to service this debt. Our debt service payments are among the highest in the country as well, the highest actually, with an average of $15,300 per household per year. So that's quite a bit of money. And as well, our households hold proportionately more short-term mortgage debt. So what that means is some of our renewals are going to be coming up faster, meaning we're going to see the impacts of some of these interest rates hikes faster than anywhere else in the country. So we've already seen the interest rates go up about 3 times since the middle of last year. So we're now sitting at 1.25 percentage points, but we are expecting another interest rate come July. So that is expected, where we're going to see Albertans, as these renewal terms start to come up, going to see that pressure a little bit more so than elsewhere in the country. So this report is saying this. It's saying a booming provincial economy and strong income gains between 2011 and 2014 emboldened households in Alberta to buy homes and accumulate significant debt, leaving them with high debt loads when incomes dropped following the plunge in global oil prices. So, Catherine, it's interesting. You would think think in places such as Vancouver or Toronto, where we've seen house prices really rising, that's where we'd see people with some of the highest household debts. But they're saying that's not the case in this report, and that's thanks to those rising incomes. That meant we just spent a little bit more maybe than we should have. So they're saying households in BC and Ontario are more indebted than the national average, but it's actually Albertans that are carrying the heaviest debt loads at this point.
What's the risk or the danger of Albertans defaulting on their debt payments?
At this time, it is hard to say, but what they've done is they've actually done a bit of a study here of what it's going to mean to households across the country if we see even just a 1 percentage point hike at this point. And bear in mind, these numbers are also taking into account those households who are debt-free, so it's skewing these numbers down a little bit. But you can see there with Alberta, a 1 percentage point hike would add more than $1,200 to annual debt service payments. And then it goes down from there, about $1,000, just a little over $1,000 in Ontario, and then all the maritime provinces are just under $600 per year for those debt service payments. But it's also noting that here in Alberta, we do have those highest weekly average earnings, and that's going to provide a bit of breathing room, meaning that people have a little bit more money to spend on some of that increasing debt. However, and here's a big however, what that means is we're not spending that money in other goods and services, and so all of that is going to have a big impact when it comes to economic growth in this province at a time that this province really needs it.
Okay, Tara, we'll leave it there. Thanks so much for the update there.
Okay, anyways, wanted to put that one up. So someone was asking me about Alberta, what's going on, and that's it. That's exactly what they translated here. Booming provincial economy and strong income gains before the oil price collapse that began in 2014 emboldened Albertans to amass significant debt, Hoog said. Average household liabilities in the province rose to $192,000 in 2016 from $164,000 in 2010, he said. That compares with $174,000 in British Columbia and $154,000 in Ontario. Other provinces are well below the national average debt load of $141,000. So this is, Alberta is going to face the highest debt crunch right now because of this. They're in a debt crunch right now, Albertans. They have the highest household debt, and other sectors of the economy will suffer. Now, let's talk about Aussie. Aussie household debt climbs to all-time high. This is from the beginning of the month, so this is after Q1. Numbers: the Reserve Bank of Australia, RBA, has released its debt ratios for December quarter, which revealed that Australian household debt loads have hit another all-time high. The ratio of household debt to disposable income hit 189%, and the one in Alberta was 176%, right? Or 170, really close. But I think they're also factoring in the people who are free and clear without debt too. So that's bringing the number a bit down, just like the lady said in the other one. Here's let's go back to the top of this. This is Australian household debt to disposable income. Holy smokes. So how are these people buying food? I don't understand. Food is not cheap. I don't know if anyone's been grocery shopping the last 3 years. The price of food keeps going up. The price of oil goes down, which you would think manufacturing and transporting the food would be cheaper, but no, it keeps going up, and the price of gas goes up when the price of oil goes down because we're so heavily dependent on friggin' oil. In Canada, though. Okay. Australia housing debt to disposable income. Australian debt to GDP. That's a very important one right here. But I don't follow these numbers, eh? Everything's maxed out. But I don't really follow what to GDP, because GDP is always manufactured in a way to package it, to make it look good on the grand world stage, to show other countries, look at us, our GDP, and look at us. They can manufacture and swing numbers anyway when it comes to a global level. Mortgage debt also hit a record high, 96% of GDP in the December quarter. Holy smokes. And mortgage rates to interest payments. So the mortgage rates This is interest payments. So interest. So people that are on interest-only loans are screwed because they haven't brought down or paid down the principal amount of the initial loan when it was signed. If anything, sometimes it goes up, I've seen, because of fees and contract fees and crap like that, and appraiser fees and all that Mickey Mouse and all that jazz. I've seen it go up before more than what you paid down over all those years. A version produced by BIS that includes the principal payments called debt service ratio shows the Australian household debt repayments are way above the Anglosphere nations. So this is Canada, UK, United States, and Australia. So, wow, look at Australia, eh? Wow, Canada's right there. Canada's just getting up there. And there's the UK. And then right below it is the United States of America, which is still in danger territory. But this is, you know what? Push the reset button because it's broken. Australian housing assets to disposable income has gone up. So it looks like people, like I said, with their disposable income. I know wages have been going up in Australia a lot. Is wages growth or about this? Someone's commenting there. Eh? Insurance. This is a crap. So that's one. RBA, Royal Bank of Australia, financial risk easing, but high household debt a concern. Like I said, guys, blended interest rates are really bad. And what's blended interest rate? When you're paying 8% on this card, 9% on this whatever Capital One, and 12% on American Express, and 6% on your line of credits, and 4% on this, and then 9% on that, and 12% on this. And then you have those big box store cards where you're paying 30%, 25% a year. Works out to 1.7 to 2% a month. People don't see those things, you know. I have a friend that has a Canadian Liars card. He's been paying his Canadian Liars like $4,000 for the last 5 years, and he still hasn't paid it off because it's so the rate's so expensive. You know what I'm saying? RBA financial risk. The Reserve Bank's latest review says the potential for economic shocks increase by practices of the past. The buildup of financial risk in Australia's households has finally started to ease. But the worryingly high level of household debt we have accumulated in recent years will take years to wear off, the Reserve Bank says. The RBA has published its latest review of the health of the financial system. Let's see if it's here. Ooh, it's all PDFs here. This actually goes into in-depth. It shows you the global financial environment. But I don't trust the bank, what it has to say. The bank is the one that's put a lot of people in jeopardy, trying to put junk loans on the books just to reach numbers, and you know, and lenders lying about people's income, underwriters approving deals that they know will fall apart in 6 months. It sucks. But it has drawn attention to the high level of household debt, saying it increases the risk of future economic negative shocks being amplified across the economy. The ratio to total household debt to income has increased almost 30 percentage points over the past 5 years, almost 190% after having been broadly unchanged for close to a decade, the review says. So, Australian household debt to income ratio is high relative to many other advanced economies, including some have also continued to see a strong growth in household lending in the past crisis period, such as Canada, New Zealand, and Sweden. So, oh, you know, donated $1. Yeah. So, just wanted to throw that out there. And that's just a picture of the housing there. And RBA financial risk, I just read that. And this one's an interesting one. Canadians with reserve mortgages can lose their homes if they miss a tax payment. So let's get into what is a reverse mortgage in case you don't know. Reverse mortgages are a booming sector in home equity loans. reversed for seniors. So, you know, you see those commercials now up, you know, early in the morning when old people wake up and they see, are you retired and have a home? Well, we could help you ease blah, blah, blah. Well, this is what these things are. A reverse mortgage are booming sector for home equity loans reserved for seniors. A senior homeowner can receive a loan against the equity they have built in their property. The interest quietly racks up in the background and roughly the same rate as the HELOC. The big difference is that as CHIP, the only provider of reverse mortgages in Canada so far, says no payments have been made until the borrower moves out or dies. A small exception: if you miss a property tax payment, you also have to move out or pay your lender's legal fees. What? So that's reverse. Oh, that's $3 billion. Wow, that's a lot of money. Taken to courts, brief default, house and legal fees owed to lender. Reverse mortgages aren't new to Canada. They have been around since 1983. However, they have been a relatively small portion of the lending until recently. Increasingly, house-rich boomers have been turning to the segment of lending to supplement retirement. Hopefully, they understand the full terms of those loans. So it's kind of scary if you took one of these, if you took some of these. I know in the US, when I was down there, they'd have these, are you over 65 and own your home? Well, we could help you get that RV. We could help you, and that's what puts people in these positions. And I hate seeing older people getting taken for a ride. My mom recently was taken for a ride. There was a bunch of people crank calling. It was about a year ago. People were crank calling her, saying that they were Canada Revenue Agency, that she owed money, and if she didn't pay the money, they'll put her in jail. And my mom got nervous, and she went to go pay these guys. And it was this big scheme that was out of India or Pakistan, and they were calling people in Canada, trying to get them, you know, saying that they're Canada Revenue Agency, and if you don't pay, we'll put you in jail. And a lot of people fell for this crap. So sad, but it happens. You know, my mom was taken for a ride. I think it was almost $2,200. So I told her, next time someone calls, tell them to send it in writing in the mail. If it doesn't come in the mail, they could go ahead and do whatever they want to do, because if it doesn't come in the mail, then there's no way they could contact you. There's no way that they're over the phone. You could cold call people. You could cold call anyone over the phone with a white pages. Go get your white pages, and you could cold call people. But if they can't mail you something, then you got a bit of a problem, right? So, and this one here is from CNBC, Canadian News Broadcasting Crap. Why buying a home can be almost impossible with massive student loan debt. So this is a really interesting article. I'm going to leave this with you guys if you have student loan debt and trying to get ahead. The article's called Why Buying a Home Can Be Almost Impossible with Massive Student Loan Debt. I've been talking for over 40 minutes, guys. And let me know what you guys think in the comments below. This is all over. This is everywhere. This is starting to get out now, and I've been talking about this for the last 6 years. When I've been telling people, it's like, why are they paying this much for a house? 6 years ago, homes were a lot significantly cheaper, but they were still overpriced 6 years ago. Still, and I never bought. Look, I'm not gonna buy that. Like, was $680,000 for that? And then now the same house is like 1.2 million, but people are like, but Mike, you could have bought that and doubled your money. It's risk. I rather risk my money in stock markets and other markets and equity markets and gold and silver, and hedge against inflation and blah blah blah, and investing in futures markets. That's where you invest in, and that's where you get returns, interest. I have what do you call those stocks that pay out dividend stocks? You know, to start building for my retirement, stuff like that. You know, but it's real estate. You know, like, I mean, it's, you know, unless you're Donald Trump and you buy 90 homes in one time, fix them up and sell them in 2 months, or, you know, a deadline of 2 months. I don't know. Comment below. Let me know what you guys think. And I'd like to know your feedback. Thanks for watching.